saw this week, in the last 7 days, we saw our lowest year-to-date 30-year fixed mortgage rate. And we also have seen in the same week basically all the momentum that we've been seeing over the last 3 and 4 weeks on 30-year fixed mortgage rates completely wiped out in a 24, 48-hour period. So we've seen both things, the lowest year-to-date rate on mortgages, and we've also seen all the momentum from the last 3 or 4 weeks just cleaned out. And so why did that happen during the same week that Jerome Powell and the FOMC, the committee that makes these decisions, when they decided to make that cut here during the September meeting, which was Tuesday, Wednesday, announcement Wednesday afternoon, why did we see those two things happen? Brian, I'll get your reaction to it. You're dealing with, consumers directly on mortgage rates. And what's your reaction to what we all knew was coming, the Fed's decision to cut, and then what's happened since with mortgage rates?
Yeah, so I'm not surprised. I'm a little bit torn. Part of me wants to say, I told you so to a couple people, but I'm not going to do that. I'm going to take the high road. And part of me wants to say mortgage rates are still really good compared to a month ago, which they are. So I'm still happy with the current rates, but they did go up a bit.
I'll also just say the last 50-year mortgage rates 7.55, on the average, and we're under 6.5. So when you look at historically, we're still in a spot that's not terrible. But I get it because it's still very, with how much prices have gone up the last 4 or 5 years, it's still, and you have the acceleration of rates going up that took place because of how the Fed had to play catch up on inflation after they printed all that money. It's extreme. Like, humans don't react well to extreme change. Okay. Slow change over time, more acceptable, but this extreme rapid change that everybody seems to be so addicted to lately, the human race just doesn't react well to that. And so, you survive, but one of the survival tactics has been just locking in. And that's why you're seeing less transactions, less purchases, and all of that, because the higher rate coupled with the higher prices is making it, very challenging for buyers.
So for those of you who haven't been paying as close attention to this as we have, let me just take you down a quick recap of what's happened, and then we'll talk a little bit about why it happened. So average 30-year fixed rate, according to Mortgage News Daily, on Tuesday of this week hit 6.13, which was the lowest it was all year, before the federal funds rate cut, before the Fed meeting. If we look back to about 30 days ago in August, it was 6.61, and back in May it was 7.08. So we saw the day of the rate cut, it was pretty volatile that afternoon. I actually, in the first 45 minutes after the Fed meeting, it looked like rates were getting better, and they were briefly. And then it started to go the other direction. They ended the day on Wednesday, which was the day of the rate cut, at 6.22. And then the bonds kind of went in the other direction on Thursday, the day after the rate cut, ending the day at 6.37, up about 0.25% compared to 2 days earlier before the rate cut. So we saw a pretty significant spike in rates after the rate cut. And so we could talk about why that happened, but that's what happened.
Yes, that is generally what happened. I will jump in and just clean up one part of what Brian walked us through there. If you were following it in real time, not expecting anybody listening to Real Estate Radio to be following this in real time, but if you were following the 10-year Treasury, which is what 30-year fixed mortgage rates actually follow, the 10-year, in real time, when the news was released that the 25 basis point cut was confirmed that everybody expected, that was in addition to the release of the quarterly projections. So once a quarter, we had one in June, we had one now in September. This was a meeting where the Fed releases their SEP, they call it, which is a summary of economic projections. So they have projections moving forward over the next couple of years on things like unemployment, inflation. But one of the other projections that is in this report every quarter is how many rate cuts, or where they, the federal funds rate decision, where they are going to land on that, or where they project rather to land on that on a move forward basis. And the next couple meetings, obviously, in particular, October and December, are of, those meetings are under a microscope for investors. They want to know what's going on. And so the headline immediately out of the Fed meeting was this September cut, and the consensus vote on the projections was 2 more cuts coming this year. One in October, one in December. When that news was released, that is when the 10-year dropped that afternoon, Wednesday afternoon, and dropped under 4. Okay, we broke 4, which we haven't done in, we broke 4, and we hadn't done that until, you got to go back to, I think, October of last year. Yeah, October of last year would have been the last time that we have broken 4 on the 10-year. Okay. So we broke 4 momentarily, and it hung there for a period of time. The period of time that the Fed released their statement on the meeting, their written statement, that Jerome Powell read the prepared statement. When did it start going up? The minute Jerome Powell had to articulate the committee's thoughts to the press in a question and answer segment. And then is when the 10-year started to go up, and everything changed the minute the Fed chairman opened his mouth.